Hi, Des O'Neill here. Today I want to talk to you all about the new small entity reporting regime and financial statement presentation under Section 1A of FRS 102 and Companies Accounting Act 2017. Yes, another change in the financial reporting regime. Now, Section 1A has been in the pipeline for a long time. And the most common question we get is, well, how is Section 1A going to differ from FRS 102? But people are still thinking in terms of old GAAP. So they like to know, well, what does it look like from an FRS 102 perspective? How is it different? Because Section 1A, obviously, it's a subset of full FRS 102. But okay, so how do our accounts look different, and what is the treatments that are different if we were still using old GAAP, which went out a year and a half ago, 2 years ago? So first of all, Section 1A and when it applies. Section 1A of FRS 102 is required for periods commencing after the 1st of January 2016, but early adoption should have been available to us for periods commencing after the 1st of January 2015. So this new small entities regime, it's a subset of FRS 102. And it really, I suppose, Section 1A of FRS 102, it really replaces the frizzy and financial reporting for smaller entities is what Section 1A does. Now, the difficulty in an Irish context, and this has compounded the transition problems under FRS 102, is that Section 1A could not be applied for periods commencing 1st of January 2016 in Ireland because it required the commencement of Companies Accounting Act 2017, and Companies Accounting Act 2017 was only commenced in June 2017. An important distinction here, you've got to remember, Companies Accounting Act 2017, that must be applied for all periods commencing 1st of January 2017 onwards. In other words, your 31st of December 17 year ends, but Section 1A is actually optional for small companies. So you must adopt Companies Accounting Act 2017, but Section 1A will continue to be optional. Now, I would strongly suggest to you that where Section 1A can be availed of as a small company, and in a couple of minutes we look at the size thresholds, when Section 1A can be availed of for small companies, that you do avail of it. You see, we're not just dealing with Section 1A here, we're dealing with Companies Accounting Act 2017, and Companies Accounting Act 2017, it has changed not just the financial reporting for financial statements, statutory financial statements, it's also fundamentally changed the extent and level of detail required in the disclosures in abridged accounts for small companies. Logically, this is about creating a financial reporting regime that is appropriate depending on the size of the entities. So if there's a small entity reporting regime, it's logical that we would adopt it so that we don't end up over-disclosing in the public domain for small companies. Now, you see, I suppose Section 1A, it comes in tandem with the introduction of FRS 102 and FRS 105. Like back in 2016, all of our old accounting standards were replaced. And previously we used to have FRSs were drip fed in, replacing the old SSAPs. But back in January, February 2016, can you remember back to it? Like it was the single biggest change to financial reporting in the modern history of the profession. We didn't just change a standard, we changed an entire regime all at once. And the difficulty, of course, being that the transition to FRS 102 was tough, but for Irish accountants, well, if we had Section 1A of FRS 102 available to us and micro-entities available to us under FRS 105, things would have been a little bit easier. But that wasn't the case. So 2016 was a horrific year for accountants in terms of transitioning to full FRS 102. Now, in 2017, things were just stabilising again, and now in 2018 we have more changes again. It really has been difficult for the accountancy profession. And you know, this change, like who's paying for it? Who pays for all this? You see, the accountancy profession, or at least the SME accountancy profession, you didn't necessarily ask for the change. And we could argue, oh, well, FRS 102 and Section 1A of FRS 102, it doesn't have necessarily a huge impact on the financial statements. There's change. And every time we have change, it takes time. And accountants, they usually don't get paid to implement all these changes. Like, from a client, do your clients care? From a client perspective, anything to do with financial reporting, like, that's the accountant's thing. It's not the client's thing. Like, clients, they usually just don't get this stuff. This is your thing. This is the accountant's thing. You see, from our perspective, accountants do not have the time to plough through FRS 102, FRS 105, Section 1A of FRS 102, and Companies Accounting Act 2017. There's just not the time. Analysing the detail, understanding the minutiae, learning disclosure requirements. Do you know, although they're not important, they may not necessarily be relevant to all your clients. The thing about FRS 102 is, do you know, we need to get this stuff right, and we need to know that when an issue comes up, that we have the knowledge to deal with it. Here's the thing that we are finding. We work with hundreds of accountancy practices every year, helping them prepare for their monitoring visits, helping them recover from their monitoring visits. We do annual compliance reviews. Our technical help desk is hopping constantly with phone calls. And what we're finding is, despite the fact that FRS 102 is in for 2 years, they're still finding accounts with fundamental mistakes in them. Hopefully, your accounts are up to scratch and up to speed. Now, let's be honest here. All these changes, that's not an opportunity for the profession. As our financial reporting framework changes, it's not an opportunity. Clients don't get excited about stuff like this. They don't even understand it. And as per usual, with the accountancy profession here, you earn every penny you generate in fees. Like, the real opportunity here is about minimizing the impact and making your life as simple as possible. Like, Section 1A of FRS 102, it needs to be made practical. FRS 102 and Section 1A, they need to be made simple. The implementation of Section 1A, it's about efficiency. How can we get our accounts right? We need to get up to speed with the detailed application, get our disclosures right. Because the biggest thing for accountants with all financial reporting is to do this and get it right without costing an arm and a leg in terms of time. And this is what we are here to help you do. You see, sometimes I think the accountancy profession gets sucked into compliance and accountancy standards and requirements, and it loses sight of the most important thing. The most important thing being providing value to the clients in the areas they want it, and accountants making a profit for themselves and their clients. Even in something like this, the business of accountancy needs to be the primary focus. So, what do I have to share with you? Let's go take a look at FRS 102, Section 1A. Now, before we go any further, I want you to download the 2 free guides I have for you that goes with this video. So, the first free guide, which we're going to look at now, is our FRS 102 Section 1A quick guide. And the other document that we have is a sample set of financial statements setting out the disclosures in accordance with Section 1A of FRS 102 and highlighting the changes from full FRS 102 under Companies Act 14 to Section 1A of FRS 102 under Companies Accounting Act 2017 as updating Companies Act 14. So download, press pause, download the 2 documents, get them on here so that we can go through them together for the next 15-20 minutes and that I can give you some real value. Okay, so first of all, let's look here at our FRS 102 Section 1A quick guide. So our FRS 102 Section 1A quick guide, if you go in here to the very first page, we have details of Companies Accounting Act 2017 and when it came into play. So the Companies Accounting Act 2017 commenced on the 9th of June and it introduced the small companies regime, allowing Irish entities for the first time prepare financial statements under Section 1A of FRS 102. So any set of financial statements signed off on or after the 9th of June 2017 could adopt Section 1A of FRS 102. Now watch this for a second. Companies Accounting Act 2017 came in on the 9th of June. There was an option of early adoption, but compulsorily companies must adopt Companies Accounting Act 2017 for periods commencing 1st of January 2017 onwards. In other words, 31st of December 17 year ends. So your 31st December 17 year ends, they've got no choice. They must adopt Companies Accounting Act 2017. They do, however, always have a choice as to whether they adopt the small entity regime under Section 1A or whether they hold out and keep FRS 102. Now, who can avail of the small entities regime? Well, what we're looking at here now is we're looking at, in your quick guide, changes to the size criteria. You see, previously it used to be companies that had an 8.8 million turnover, 4.4 million balance sheet, and 50 employees that were Companies Act 14 requirements for what's a small company. Now what they've done under Companies Accounting Act 2017 is they have jumped here to 12 million turnover, 6 million balance sheet and 50 employees. So more companies can avail of the small company exemption. Now that small company exemption, not only does it open the door to Section 1A of FRS 102, it also opens the door to audit exemption. Look at it, 12 million turnover, 6 million balance sheet and 50 employees. How many entities do not have or meet those criteria in an Irish context? The vast majority of Irish entities will meet 2 out of 3 of those criteria. Now, the Companies Accounting Act 2017 does introduce a new concept. This is the concept of holding companies for small groups. So the small group threshold, the consolidation threshold has now dropped. Previously, the consolidation threshold was 20 million turnover, 10 million balance sheet, and 250 employees. Now it has dropped back to a 12 million turnover, 6 million balance sheet, or 50 employees. So that defines small companies. Now, the good news is, even if you are preparing consolidated accounts for a company, the parent company may need to produce accounts under FRS 102, but the subsidiary entities, if they meet the definition and size criteria of Section 1A, well, they can actually produce accounts, standalone accounts under Section 1A. You see, here's the beauty of Section 1A of FRS 102. It is FRS 102, just with reduced disclosures. So sections 2 to 35 of FRS 102 continue to apply. What Section 1A does is it reduces the level of detail, the accounting policies, everything in sections 2 to 35 of FRS 102, but the extent of disclosure and the notes to the accounts is significantly reduced. Now, it says that small companies, if they meet this size criteria, in the current and preceding year, meeting 2 out of the 3 criteria, can avail of the small entities regime, but it goes on to give specific exclusions. So the specific exclusions are, under Schedule 5 of Companies Act 2014, if an entity is a Schedule 5 company, in other words, an authorised investment firm, an insurance intermediary, or any other company carrying on the business required to be authorised by the central bank, well, they're Schedule 5 entities. Irrespective of size, they cannot produce Section 1A FRS 102 accounts. They must produce full FRS 102 accounts. They also say that if it's a company that's a credit institution or an insurance undertaking, a company with securities regulated on a regulated market, or a holding company in a group where one of the entities meets, most commonly, a Schedule 5. So if we have a parent here and we've got subsidiaries, and these subsidiaries, everybody meets the definition of small, so let's say it's a small group. Well, even if it's a small group, if this entity here is a Schedule 5 entity, as a Schedule 5 entity, it must produce full FRS 102 accounts. But even though the parent may not otherwise have to consolidate based on the group size criteria, because it has a subsidiary that is a Schedule 5 entity, this parent company here must also now produce FRS 102 accounts and consolidate. Watch your regulated entities and watch your regulated entities within a group. They cannot avail of Section 1A, and that has knock-on consequences for everybody in the group. So, we've already covered, well, what remains the same. Sections 2 to 35 remains the same. Section 1A, it's really about disclosure exemptions. So, what is new here? What is different? Well, we've set out here within your quick guide. So within your quick guide, we've set out the principal disclosures under Section 1A, what is different in our director's report, what is different in the primary financial statements in terms of your profit and loss account, your balance sheet, your statement of changes in equity, your cash flows. Well, here's the good news: cash flow statements, we don't need to produce cash flow statements. Now, there is one thing I want to highlight for you here. When you look at Section 1A of FRS 102, there are certain things are required and certain things are encouraged. So this basic checklist here is, in a nutshell, in 3 or 4 pages, we've given you, well, here's the minimum disclosures required under Section 1A of FRS 102. So we've broken that down. Now, obviously, you need to have more detailed disclosure checklists. When you're using a disclosure checklist on file, you need to have more detail than what we have here. But what's this required and encouraged? Well, there's certain things are required at a minimum, but what they've also done is they've identified certain things like, for example, a statement of changes in equity. It is not required. However, if there's a movement of profit and loss reserves to be disclosed, including details of transfers, movement on revaluation reserves, movement on fair value reserves, that you should consider disclosing them if the movement is not presented elsewhere in the notes to the financial statements. So there's the minimum requirement that you must disclose, but then there's these additional things that they're warning you. Well, consider making disclosures. Consider making disclosures in relation to these items. So, what are some of the encouraged disclosures? Including a statement of compliance, not required, encouraged. This is where, if we transition to FRS 102 for the first time, if an entity is a public interest, a public benefit entity, it would be not required, but it is encouraged. And then they talk about other items here. As you go through, we've got all the notes, all the detail of what is specifically required under Section 1A of FRS 102. So this quick guide, it really dovetails into the second handout that I have for you today, which is our sample company Section 1A FRS 102 set of financial statements. The idea behind the quick guide is, well, the quick guide gives you, at a flash, at a glance, here's all the requirements. The financial statements, well, what they do is they now bring this to life and practically show you and practically give you, well, here's what my accounts actually look like. We've been doing what we do in OmniPro for coming up on 15 years. And the one thing in relation to financial statements and getting financial statement disclosures right, for me it is critical that you have a financial statement disclosures checklist that's current and up to date, but that every time we're producing a financial statement, whoever's pressing print on that printer in the office to produce a set of financial statements, that they have a pro forma set of financial statements like this in their hand so they can visually call over. Now, one thing you will notice in the pro forma financial statements is we have very detailed footnotes and explanations. These footnotes and explanations for me are critical. We're laying out the set of accounts, this is what they look like. But the footnotes and the explanations, this is what gives context. This is what helps you understand, well, where does it come from within the FRS? Where does it come from within company law? So the footnotes, I was down with a firm only last week, and the firm was saying to me that, yeah, that they were looking at the accounts and they just think the footnotes are brilliant because the footnotes, it allows them understand the context, it allows them educate themselves and get better for themselves. So let's dive in here and look at some of the key changes in financial statements as we move from full FRS 102 back to Section 1A of FRS 102. Okay, so we've looked at the size criteria. In here, we identify, on page 2 of your accounts, we identify, well, here are your Schedule 5 entities that cannot avail of the regime. Then what we have is this full set of accounts, everything here is color-coded. So everything is color-coded. We've identified all the changes in red, anything colored in blue. It's encouraged under Section 1A in order to show true and fair view. We just looked at that. Anything highlighted in green, well, they're required if they exist, but they don't exist in this company for educational purposes. So everything here is color-coded so that you can literally have this set of accounts in your hand and see, well, what are the differences here? What are the changes as we face into 2018 and new reporting formats? Okay. So watch here, a change now. We previously would have had this for most entities, that we would have disclosed the CRO number and the registered office address. But you do need to watch that. That is a requirement under Companies Accounting Act 17. So make sure that this is disclosed on your information page. One thing that surprises people is that the information page is actually not a requirement. It's really only best practice. Change in the financial reporting network, or in the financial reporting framework. We have this highlighted in yellow here. Look, if we're doing a 31st of December 17 set of accounts, 31st December 17 accounts are not going to have transition adjustments. We've prepared this sample set of accounts showing you transition adjustments just in case you have now a late filer who's preparing accounts under Companies Act 14 and Section 1A of FRS 102 who's never transitioned before, but for the future. So for the future, so if you have somebody who they've gone to FRS 105 and now they're changing back to Section 1A of FRS 102, you only put in this commentary in relation to change in the financial reporting framework if the entity is actually changing. You will see here our principal activities has changed. We used to have a requirement in here to put in detail in relation to the KPIs and the non-financial KPIs under Section 327 of the Companies Act. That requirement to do principal activities and business review is now gone under the new legislation. And watch here, this is dealt with in here specifically in footnote 6. Now the writing is obviously a little bit small for this screen and for this presentation, but just be aware as you look at the set of accounts of the information that previously was required in the director's report dropping out. So the requirement here to disclose the details of directors and secretaries' interest in the abridged financial statements, you still have a requirement to disclose that in the financial statements in the director's report, but you do not have a requirement to disclose it in the notes to the abridged accounts. So that is a change, and that is something that is dropping out. Small company exemptions, this is not required. We would see this as best practice. Small companies exemption, I will show you in a couple of minutes where you absolutely have to put in a note at the foot of the balance sheet where companies have availed of small companies exemption. For us, it's just logical that you would put in information like this in the director's report. Okay, so moving on through. Now, one thing that I want to clarify for you, obviously, we have new auditing standards, and the new auditing standards, the IASA Irish auditing standards, they were required for periods ending on or after 30th of June 2017. So this set of accounts here incorporates the new auditing standards, new Companies Accounting Act 2017 requirements, and it includes Section 1A of FRS 102. Why am I talking about that here? Well, from an auditing perspective, originally the guidance document which gave you the contents for your director's responsibility statement was Bulletin 1I. Bulletin 1I has now been withdrawn. So the format for director's responsibility statements that came originally from Bulletin 1I, IASA has not published a guidance document in relation to Irish audit opinions. The FRC is no longer responsible for Irish auditors. Your director's responsibility statement is now coming from guidance from your institutes and CCABI. Okay, so we have here in this sample set of financial statements, we have the audit opinion and the new format of audit opinion required under the auditing standards. Watch this. We have seen firms, we've been working with firms since January, who have missed this. They've missed this new auditing standard. Watch this. 30th of June 17 year ends onwards must apply the IASA auditing standards. We have periods commencing 1st of January 17, ending 31st of December 17. They must apply Companies Accounting Act 2017 formats. And it's not a new Companies Act, it's basically just an update of Companies Act 14. And then obviously anybody who has signed off after the 9th of June 17, they have an option to apply Section 1A of FRS 102. Okay, so there's the new format of audit opinion. Your profit and loss account. There's no significant change to your profit and loss account. There are some phraseology changes. Instead of tax on profit on ordinary activities, that phrase is gone. Now we've left in here just as a placeholder in case it arises as a statement of comprehensive income. So this is, you only put this in, it's not required, but it is encouraged if it helps give a true and fair view and if the information is not disclosed elsewhere. Our balance sheet, no real change to the format of our balance sheet, but here is a change in wording. You see, what's happened with Companies Accounting Act 2017? Well, you see, under Companies Act 14, we had Schedule 3 and Schedule 4. Schedule 3 dealt with standalone financial statements, and Schedule 4 dealt with group financial statements. What Companies Accounting Act 2017 has done, it's introduced Schedule 3A. So Schedule 3 still exists for standalone companies, but Schedule 3A is for small entities, and Schedule 3B is for micro entities under FRS 105. And then they've introduced Schedule 4A, which deals with small groups. Now, when you sign off a balance sheet, if the directors are availing of the small companies regime, they need to sign off on the balance sheet and confirm that. Okay, we've put in the statement of changes in equity. Lots of colours here. It's like a rainbow. What's happening here, okay? Well, what's happening here is the statement of changes in equity is actually optional. But you see all this stuff in red? All this stuff in red, it must be disclosed in a note to the financial statements and the abridged accounts. So in the abridged accounts, there must be a note to the financial statements containing this information. We believe most people will not do a statement of changes in equity. They will probably do a note to the financial statements for small companies, which will pick this up in the abridged accounts. The accounting policy, minimal changes here, just some phraseology references really. Now, where the changes really kick in under Section 1A of FRS 102 is when we start digging into the notes. Okay, so let's start digging into the notes. So the first note that is different, so our operating profit note, significantly less detail required here in our operating profit note. Our other operating income note, not required under Section 1A of FRS 102. Our interest receivable and similar income note, not required under Section 1A of FRS 102. Our interest payable and similar expenses, less detail and less disclosures here. Look at this is a big one. Our tax note. The tax note, the taxation note and the tax reconciliation gone in its entirety under Section 1A of FRS 102. Employees. The detailed employee note, significantly reduced. Now back to, for small entities, they don't need to disclose details of remuneration, they just need to disclose the average number of employees. But watch out here, are you disclosing the average number of employees in accordance with Section 317? Directors' remuneration and transactions. Watch the footnote on this, folks. Watch the footnote. Footnote 69 down here at the bottom of the page explains under Section 317 that we're calculating the average number of employees based on the number of employees, whether employed in whole or part of a month. It's a different calculation. And as we travel around the country, as we interact with accountants, it is a calculation that is very frequently not correct. Directors' remuneration and transactions. There's no significant changes to this note. There's a small change where now instead of disclosing the maximum amount owed during a period, you're just disclosing the amount written off. But watch what the issue is here. Watch what the issue here is, because footnote 70, again the small print at the bottom of the page, directors' remuneration. It's not just directors' remuneration, it's remuneration to directors, de facto directors, shadow directors, and it is remuneration to directors and connected persons. Connected persons as defined by Section 220. Spouse, civil partner, parent, brother, sister, child. This is the family of the directors. That disclosure note, we need to put in detail of directors and connected persons remuneration. That's a very common mistake. So there's that change about the maximum amount written off instead of the maximum balance owed. Our tangible fixed asset note, we're back now to, they've corrected the error. We're just disclosing the current and preceding year like we used to pre-Companies Act 14. Financial assets, look what's gone here. Previously in financial assets, we used to have to, for small companies, disclose the name of the entity, the shares held in the entity, the registered office address, and we had to disclose the entity profit and loss and reserves in the current and preceding period. No, we're back. We're back. Significantly simpler. We are back just to showing, well, what is the cost of the investment? Significant reduction in the requirements of Section 315, 316. Stocks. We don't need to talk about the lower of cost and net realisable value. Debtors, creditors. We actually don't need to break down tax creditors at all. We can just show tax creditors if we wish as one heading. Now here we've actually broken it down. But again, footnote 84 explains why we have broken it down and that it's not required. Look at this. Loads of red. Finance lease contracts and maturity analysis, not required. Provisions for liabilities, not required. Financial instruments, not required. Now, many of you will actually be right by being wrong, because what we found was the detailed disclosure in relation to provisions and the required disclosures under Section 11 of FRS 102 were not being met. Thankfully, small entities don't need to make these disclosures. Now, you still do need to make disclosure of provisions, but not the in-depth disclosures that were required under full FRS 102. Your share capital note is gone. Everything in here in red is gone. Now, it's changed. There are some additions here in terms of the detail on capital commitments. But I think, as you can see, there is a substantial change here in the level of disclosure. Like I said earlier, watch the abridged accounts, because pretty much everything that goes into your statutory Section 1A FRS 102 accounts now goes into the abridged accounts. So that's the key elements of Section 1A FRS 102. And the next big question we're being asked at the moment is in relation to FRS 105 and the microentity regime. So I'm planning on doing a short video on the key differences in the coming week, so keep an eye out for that. I would love to hear your thoughts, comments, concerns in relation to FRS 102, financial reporting, implementation, and more to the point, what's your biggest challenge right now? So please leave your comments in the box below, and we can tailor our future trainings in this series to reflect what you want covered. So just drop a comment below and we'll take it from there. So, and don't forget, if you found this video of benefit, if you found this mini workshop series of benefit, hit the like button, share the video with your colleagues if you've got some value out of it today. So, for now, wishing you all the best, and remember, we're only ever an email away if we can be of any service to you or your firm. Talk soon, bye for now, and in the meantime, let's get it done.